Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Fresh signs of concern in China. The property sector delivers a blow to risk this morning, and global risk appetite shifts. Wall Street's picking up the pieces as the higher for longer mantra sinks in and stocks flash a recession warning. Some signs of hope elsewhere. The U.S. Transportation Secretary says UAW and big three car makers can strike a win-win deal. Meanwhile, the end of the Hollywood strike, it could be near. A very good morning to you. We've just shifted gears quite dramatically in the past 30 minutes. What happened? The world began to look at China and a third of a billion. That is a third of $1 trillion, $327 billion worth of debt, which is mounting at Evergrande and a liquidation risk. You were told it was supposed to be contained in China. It's shifting out to a global week of risk off. S&Ps were down 3% last week, NASDAQ down 3.3%. And there's something else going on in the underbelly of the market. We have industrials flashing a recession. Yes, that word is back in the form of a market narrative. Industrials down 8% from the peak. Russell 2000 down 11% from their peak. And money is gushing out of stocks at a global level. $17 billion walked out the door of equity risk last week. The NASDAQ continues lower this morning. Higher for longer is the real sort of narrative here. And Europe is under pressure. The miners are at the bottom of your screen. The reason why we have that, they're down 2.3%, is because of the Evergrande debt woes, Danny, and that's the bottom line. We're looking at one of the worst weeks for markets in equities since the SVB crisis. And this morning, yes, it may well be contained in China, but Evergrande risk is pervasive, it's live, and it's crossing borders.
Manus, that's why oil is so interesting this morning, because even though all the other commodities are getting trashed this morning on the fears of the property crisis in China, oil is still marching higher. Brent crude trading at just under $94 a barrel, up 0.6%. Perhaps it is the U.S. stockpiles that have collapsed. We've also heard warnings from J.P. Morgan saying an oil super cycle is on its way, saying we're heading to $100 a barrel. Or it could also be those hedge funds turning sentiment, boosting their bullish WTI positions by the most since February of 2022. Either way, no cracks there despite the China narrative. Now, the euro, a lot of cracks here. 10 weeks in a row. 10 weeks in the row, the euro has weakened versus the dollar. That is the worst run since the common currency was created about 20 years ago. So we are looking at also hedge funds at the same time. They're also getting more bearish on the currency. They've boosted their bearish positions to the most extreme level in about a year's time. Meanwhile, the 10-year yield, that is also climbing higher, 5 basis points. It's duration that has been under pressure. We had a little bit of buying last week, but the curve steepening is still in. Manus, that trade is very apparent, and it's coming at a time that, sure, the economy seems like it's been able to handle those higher rates, but we're about to have a quadruple whammy of potential shocks that are fully out of the Fed's control, be it oil, be it loans, be it strikes, be it at the same time China and a shutdown. Okay, that's 5, a little bit more there, Manus. But there's a lot here to contend with at the same time, you're seeing some corners of this equity market whispering about a recession.
And it is whispering, or it's beginning to howl a little bit louder. I like the way you frame those risks. They're not exogenous risks, they're known knowns rather than unknown knowns, to channel the ever-famous Rumsfeld. But looking at your yields, Danny, the question is this. You've got Bank of America saying yields can march higher to 4.75%. Ben Amons makes the point that whilst you're at 15-year highs, you're still 75 basis points away from the maxed out levels of 2006 and 2007. And that yields, in his view, Ben Amons at Medley Global Advisors, yields are too low for the extra duration risk. So again, Danny, we've got the recession on one side, which could take these yields lower, with that other concern about duration risk. Good morning from New York.
Good morning from London, Manus. I mean, hopefully it will be a good morning, but as you pointed out, we had everything turn, stocks turn pretty quickly. Now, there are those fresh signs of debt woes coming from the Chinese property developers. Let's get into a little bit more, because China Evergrande Group certainly running out of time to get back on track with its restructuring plan. We have concerns mounting. The latest setbacks included a last-minute cancellation of credit meetings and detention of money management unit staff. Raises the risk, all of that, of liquidation. The developer's restructuring plan would be one of China's biggest ever. Now, this is happening as stocks in that sector fell more than 6%, marking its worst session in 9 months. Now, joining us on this risk is Klaus Baader, Global Chief Economist at Societe Generale. Klaus, always such a pleasure to see you. Thank you for coming in. Look, at what point do you look at this housing crisis and say, despite the stimulus China has injected, this will overshadow it all?
Well, I think that's already happening. But, I think what really the key risk is there going to be an implosion, i.e. a financial implosion? What people, I was at Lehman for 10 years, a Lehman moment. And I don't think that that's going to happen, because you must not forget that basically the entire financial sector in China is government-owned. But the fact is that the Chinese government has been, I think I saw in your service there was a very good headline, which was no bazooka but lots of pistols.
Yes.
And that's exactly what the Chinese government has done. It's kind of a piecemeal attempt at stabilizing the economy and stabilizing the housing sector. I think the housing sector, can be stabilized. What I'm much more concerned about is, will you be able in China to rebuild confidence in the private sector? And that, I think, is the much bigger challenge.
Klaus, good morning. You stole my line, no bazooka, but many pistols. And of course, we've seen incremental moves from the triple Rs, a couple of triple Rs. Another one will come live now, or has just gone live, I should say. So you feel confident that this risk is contained, the Chinese can handle it. So there's absolutely no global reverberation, or where does the shoe fall on the reverberation as a result of the implosion in the housing market?
Well, I certainly wouldn't agree with that there are absolutely no reverberations. The Chinese economy is going to grow a lot less quickly than it has in the last years. In particular pre-COVID. And I don't think that that's going to change. And that, of course, affects not only direct sales of companies to China, but also, indirectly, i.e., suppliers to companies in Germany, to Japan, for whom China is a very important market. Those are all affected. So I wouldn't say that there's absolutely no risk. The great Chinese growth story is over, and I think that it has several elements. One, of course, is the demographics, and the other one is also that I fear that the Chinese growth model has been broken, and so far no one has come up with a new model. But the Chinese economy has been, driven very substantially by the housing sector, and that's unlikely to come back.
Will a new model arrive, especially when you have, Xi Jinping really talk about not wanting the excess of Western stimulus?
Well, that's right. And of course, he's very critical about welfare, what he calls welfarism, because unusually for a socialist leader, he fears that it's going to breed lazy people. So I'm not sure that there is a new model. Xi Jinping, one of his clearly his line is, the party controls everything, and the party is present in all companies. And I think that's problematic, because no growth model lasts forever. That's obvious. I mean, in the 50s and 60s, the CIA was regularly predicting when the Soviet economy was going to be bigger than the U.S. economy. And of course, people have been speculating, when is the Chinese economy going to be bigger than the U.S. economy? And I don't think it's going to happen. Because the model of industrialization and housing driven, you can't do that forever, particularly not when your population is shrinking.
But Klaus, you reflect and you say it is about patching up the housing market, delivering some kind of confidence again to the consumer. My question to you is, these no bazookas but pistols, will they deliver the confidence that you need in the consumer versus perhaps the helicopter money and the consequences of that in the G10 nations? How do they deliver consumer confidence? What is the policy function that will deliver that to steady this situation?
Well, I think the stabilization of the housing market, housing, of course, is a huge part of Chinese households' wealth. And Chinese households save a lot because they have to save a lot, because the whole social system, the healthcare system is, very poor. And housing, Chinese households have a limited ability to invest abroad because they're capital controls. And so housing has really been the go-to asset. Now, I think how you put it, I think, is a little bit dramatic. I just read this morning about the absolutely meteoric growth in travel that's going to happen over the next couple of weeks, when the Chinese Mid-Autumn Festival coincides with National Day. So there's a lot of travel. So it's not as if Chinese consumers are absolutely buckled up. And our view is that the worst in terms of economic growth for China is behind us, but it's going to be a very moderate growth path and incomparable to what it was.
Klaus, Manus and I are never dramatic. Never. We're always very sensible.
I'm just trying to get you to rise to the occasion, Klaus.
He does that. He does that. He pushes you, He's not an easy one. All right, Klaus, stay with us.
Okay.
Much more to cover. SocGen's Klaus Baader there. All right, coming up, U.S. Transportation Secretary Pete Buttigieg is standing up for American auto workers as the UAE strikes drag on. We're going to have more on that. And we're going to bring you our exclusive interview with UBS CEO Sergio Armati later this hour. This is Bloomberg.
He is proud of being the most pro-union, pro-worker president, not only compared to the Trump administration with its anti-union policies, but really compared to any modern president. You're not going to find somebody who has more consistently stood with unions. Now, having said that, it's also the case that these auto companies can thrive in a win-win deal that does what the president has called for, which is to say that record profits should lead to record pay and record benefits for the workers who are creating all that value.
That was the U.S. Transportation Secretary Pete Buttigieg speaking on CNN's State of the Union. That was Sunday. President Biden says today he will travel to Michigan to support the striking United Auto Workers Union. Tomorrow. Joining us now is Oliver Crook. So this is a huge, well, actually, you put it in context. You're American, I'm Irish. I don't really have an opinion. Is it a huge political gamble for Biden to go and join the picket lines?
Well, it's an interesting situation, and it's a situation that doesn't have a huge amount of precedent in U.S. history, with the president going and saying he's going to join the picket line, right? This is something that we don't tend to see, and as you know, the election is next year, and in U.S. political time, that is basically no time at all. But it comes also with another unprecedented act, which is on Wednesday, Trump is skipping the Republican debate to give his own speech in Detroit, both of which are really trying to woo the workers here. But just to get the latest on the strike, we had talks through the weekend going, and really no concrete progress in terms of the headline, in terms of the number on the raises. What's interesting is that Ford was spared the expansion of the strike. Why was Ford spared? The reason is they say they've made progress on a couple of things. One, reinstating the cost of living adjustment, the increases that were scrapped in 2009 when they restructured the auto industry. This is inflation protection for the paycheck, but also the right to strike and also the enhanced profit sharing. So this is where they're rewarding Ford for having made progress in these talks, but there's still a huge amount to go, and there's a lot of dry powder. Sean Fain has only 12% of the union striking right now. They have not hit the pickup truck assembly plants, which is really where, if they want to make it hurt, they'll start to focus next.
Oliver, thank you so much. That's Bloomberg's Oliver Crook. Now, in other strike news over in Hollywood, screenwriters have reached a tentative deal with studios that include Disney and Netflix. And in a strange twist of fate, The American is now going to ask a Brit about this. Joining us now is Bloomberg's Alex Webb. But we all watch Hollywood, so we all feel the significance about this. Is this success? Is this strikes over yet?
Well, it certainly looks as though we're getting very close to it. The members of the union will still have to vote on whether they agree with the terms that have been put forward. The assumption is that they probably will. We don't yet, however, fully know the details. The union have said that they think they've made good progress and they're happy with the deal. So when we have the details of it in a few days' time, then we'll be better able to gauge the temperature of the writers themselves.
OK, well, they've certainly been on strike for, more than 140 days now. Alex, thank you very much. Alex Webb with the very latest on the Hollywood strikes. Meanwhile, you've got Congress heading into a make-or-break week for avoiding the government shutdown. Leaders of the Republican-controlled House, they're hoping that they can persuade the GOP holdouts to get on board with 4 full-year bills and a short-term funding patch. Shutdown is set for October the 1st unless Congress acts. And if no deal is reached, hundreds of thousands of federal workers are set to be furloughed. Klaus Baader is the global chief economist at Societe Generale. Our guest this morning setting the tone. Danny talked about a number of risks. None of them are exogenous. But on a scale of tail risk, a government shutdown, How do we need to look at it if it happens, if it's short, fast and furious, or if it's dragged out? What is my risk with the government shutdown, Klaus?
Well, that it is a reflection of the political process in the U.S. Being stuck and being rather dysfunctional. I mean, in the past, shutdowns have not tended to have an enormous impact on the economy. People are just furloughed. They eventually get their money, but with a delay. So I don't think it's a huge risk. There is, of course, a way out. Even if the holdouts in the GOP refuse to play ball, there's always the chance of a bipartisan deal, although that might very well mean that the Speaker of the House gets thrown out by his own party. It's just all part of this dysfunctionality of Congress and in particular of the GOP.
You previously have said that you're concerned about a U.S. default when we had the debt ceiling problem last time. How acute is that concern for you now? Is it still simmering in the background?
Absolutely, it's simmering in the background. And my concern with the inability of getting these funding bills through is only raised. And my concerns are only raised by this imminent risk that the Speaker of the House is under constant threat to be fired by his own party. So I think that risk is very much there. And what we're finding is that the resistance and the intransigence of a few people who can really hold up the whole process is becoming greater, rather than that there's an increasing degree of willingness to make compromises. So I am still concerned about that. Now, not in the immediate future, because it's not on the agenda in the immediate future, but I think it's a risk that doesn't go away. And as I've said before, I think the debt ceiling makes absolutely no sense. Congress agrees to spending bills, and they should finance it and not have a separate vote on whether there's a debt limit or not. I think that's it's an institutional flaw that shouldn't be there.
Well, it's a long old haul in politics, isn't it, Klaus? One thing is well, nothing's for sure, but we should get the PCE deflator on Friday, and we're expecting that to dip below 4% for the first time in 2 years. How close are you, as a global economist, to saying, look, we are at or near mission accomplished? Or what would it take for the Fed to go for the extra hike? What data do you want to see to confirm no hike for the rest of 2023?
Well, I think it's first and foremost about inflation. But as I've said before, it's the low-hanging fruit has been picked as far as the fight of inflation is concerned. Now, the Fed looks more at core inflation. We'll see how that develops. The U.S. is actually, compared to a lot of other economies, in a slightly better situation, because in the most recent past, labor productivity in the U.S. has suddenly accelerated, and therefore unit labor cost has slowed a lot. And it doesn't look anymore for the U.S. as if reaching the 2% inflation target is completely out of reach, which was still the case a few months ago. In most other economies, except Japan, that's simply not the case. So I think that the fight against inflation has definitely not yet been won. And, what we talked about earlier, about the wage pressures in the U.S. auto sector, that's the kind of cycle that makes inflation last, is that you get high inflation, workers lose purchasing power, they demand higher wages, and companies raise prices. That's the age-old wage price spiral, which should really be called a price-wage spiral, because usually prices move first.
Fair enough. All right, Klaus, thank you so much for joining. Unfortunately, we're out of time. Always a pleasure to have you. That's Klaus Baader of Societe Generale. Now, coming up, how much would you pay for a chance to get matched on an exclusive dating platform? Tinder figures it is $500 a month. That's its subscription for its most active users. And more on that next. This is Bloomberg.
This is Bloomberg Brief. I'm Manus Craney in New York with Danny Berger in London. Now, a story that caught my eye over the weekend. The dating app Tinder has rolled out a premium subscription service. Tinder Select, at its most active users, will pay $500 a month. The service is offered to less than 1% of its users, according to the company, with the access to features such as exclusive search and matching. Now, Danny, you can roll with this any way you want. This is the cost of love. You've got to be a power user. Question is this, right? I think I'm more the $24.99 subscription. Yeah, $500 a month to find the perfect match. What do you reckon?
It makes me want to be single. That's what I reckon. What is this? Is this like love inflation? I don't understand. This is crazy to me. Although I have to say, like, I don't think people are on Tinder paying $500 a month to find love necessarily. I won't go much further than that. But this seems crazy to me, Manus. Absolutely crazy.
Well, you know what? You know, $25 a month is enough to swipe. Go find me. The other thing is, of course, the owner of Tinder is Match, and in 2022, they bought the league. Now, get this. This is an invite-only dating app. For I don't know whether I constitute this. Tell me whether I do. Ambitious, career-orientated singles. Do you think I hit those 3 benchmarks? Apparently, it's a VIP plan for $1,000 a week.
Manus, if you're not that, I don't know what is. If you're not that, then something is broken. I'll be honest, I
think we might be stretching it at the young.
before.
I think we might be stretching it at the. It doesn't say young.
Yeah, it's any age, Manus. Love will cost you $500. Doesn't matter how old you are.
No, it doesn't. We're going to talk FX next. From love to FX, which currency is the choice for Esther Reichelt? She joins you shortly, strategist from Commerzbank, right here on Bloomberg. Welcome back to Bloomberg Brief. I'm Manus in New York.
And I'm Danny Berger in London. Here's what you need to know. Fresh signs of concern in China's property sector deliver a Monday morning blow to global risk appetite. Wall Street's picking up the pieces as a higher-for-longer mantra sinks in and stocks flash a recessionary warning. And signs of hope elsewhere. U.S. Transportation Secretary says UAW and the big 3 car makers can still strike a win-win deal. Meanwhile, the end of the Hollywood strikes may be near. Now, let's take a look on your markets, because Manus is going to get into some of the doom and gloom on this equity market. A lot of it is emanating from China. Concerns about Evergrande. We're just hearing from Klaus Baader. Yes, there are some concerns that it could come over to other parts of the world, but big-scale contagion, maybe we're not there yet. Even so, oil still climbing higher, up 0.5%, just below $94 a barrel. JP Morgan says we're going for an oil super cycle. Euro, that's also seeing its 10th straight week of declines. That is its most on record. Hedge funds there adjusting their bearish bet to the most in just about a year. Meanwhile, it's duration that has been under pressure, Manus. 30-year yield, that is off about 5 basis points. Same with the 10-year yield. We're looking at some curve steepening going on. It's everything from the higher for longer, Manus, to also the concerns of Treasury supply, shutdown, strikes. All those things are simmering in the background right now.
Yeah, and Bank of America make the point that you're probably going to see higher yields, 4.75%, Danny, in the near term, because it's the longer end of the curve where you're going to see the workout rather than the short end of the curve. You're right. When it comes to cross-asset risk, that is driving are being driven, I should say, really by what's happening on the equity side. We're going into the 4th week of a dip in these equities. We've had a downside shift in equities for 3 weeks in a row. S&Ps were down by nearly 3% last week. The Nasdaq was down 3.3%. So we've got this risk-off sentiment from Evergrande in China. It's a name that you know well. Yes, SocGen say it's contained within China, but you're looking at $1/3 of $1 trillion worth of debt on liquidation risk. And that will impact the consumer in China, perhaps not seeping globally across borders. But what you've got is the biggest outflow of this year from global stocks. $17 billion walked out the door. There is an underbelly of concern that word "or" is back in our lexicon again. Recession risk. Industrials are down 8% from their peak in August. The Russell 2000 down 11% since the peak earlier in the summer. European stocks down. That's where the real pressure is, and it's the miners at the bottom of your screen, which are down by 2%. That is the real source of angst. As iron ore comes lower, commodities under pressure. We're trying to understand the parameters of the impact of a liquidation of Evergrande. How pervasive would that be? How much contagion would that deliver? And whether that's going to cause the PBOC to come out with something much more substantial in terms of stimulus. Right now, stocks are on the back foot as we kick in at 5:32 New York time. But Danny, the debate really is about what we get on inflation data this week. We've got shutdown risk, we've got strikers, but we have the PCE deflator, and that, to a certain extent, will imbue the argument about whether you get another hike in the back quarter of this year.
Yeah, there's a lot of hope. We'll get a figure that comes under 4%. We'll get European data. There's hope there that it will start to come down. But Manus, I mean, you mentioned it. There's a lot beyond that. There's a lot that could upset things here into a week after the worst week for risk since March. We're starting on the back foot yet again.
Okay, well, then that brings you to what is your hedge? Where do you want to be? How do you want to be positioned? Let's kick off the conversation with our next guest from Commerzbank. This is what she had to say. Anyone betting on a continued dollar strength or even appreciation should realize that this is a bet on the performance of the U.S. economy, which results in increased susceptibility of the dollar against weaker economic data. Esther Reichelt is the lady who wrote the quote. She's from Commerzbank FX. Esther, I was looking at the chart. I was looking at the quote. The dollar's rallied by 5%, give or take an eighth, since the middle of the summer. That rally is either going to be driven higher. We're in this risk-off mode, but you're concerned about growth. And with that in mind, that is what caps the dollar rally. Should we start there?
Yeah, clearly, I think this is the big risk, but because there is simply a lot of US optimism priced into the US dollar. This was supported, of course, by the Fed's view, which basically said that even if we are seeing a cooling of the economic dynamics, this will not sip through to the labor market. We'll only see a very slight increase in the unemployment rate. So if this does not play out as the Fed has painted at its last meeting last week, I think there is still the potential for a rather sharp correction of the recent dollar strength.
What could possibly rally against it, Esther? What would be the currency du jour in that scenario? Because I'm guessing if the U.S. economy is turning, surely euro is not where you want to be.
Well, yeah, clearly, because, I mean, of course, we are seeing clear signs for the recession risks in the Eurozone deepening. However, this is already priced in. So, in my opinion, the risks with respect to the economic risks, the risks to euro dollar are rather asymmetric. You know, like we would need to see a very serious surprise for the Eurozone, but only a very slight surprise with respect to lower growth, to a lower growth outlook for the US to justify higher euro dollar levels.
We're at 106 on euro dollar. The calls for parity, Esther, have been picking up. We've seen it recently from Capital Economics. What do you think? Parity? We're going to see it sometime soon this year?
I'm rather doubtful. As I said, I'm still thinking that right now the upside is more attractive because in the end, you should not you should keep inside the huge inflation risks. You know, we've heard it before in your show. The fight against inflation is not yet won, and this is, you know, like inflation is showing very much a global pattern, you know, like, so either inflation goes down everywhere or inflation might stay up everywhere. I don't think that we are seeing a very significant divergence in dynamics, inflation dynamics in the Eurozone and the United States. So I doubt that such a significant move in euro dollar would be justified.
One of the big debates, Esther, is whether you see a vicious second round pump higher like you saw in the 1970s. I do read the research. I went back and had a look. You talked about 1976. You talked about 1979. And you talk about the re-emergence of a second round pump in inflation. I look at oil. I've got a number of houses telling me there's a super cycle coming, a renewed super cycle in the oil market. What is it that you see that could deliver that second round, really a second round pump higher in inflation globally?
Well, I think it's largely really the underlying risks stemming from the labor market, because to be honest, we simply are not we don't know very much about what is driving recent inflation dynamics. I mean, like central banks were surprised by the pickup in inflation in 2021. They were surprised on how robust inflation developed in 2022 and even in 2023. So what is giving us the confidence that everything will decline in exactly the way the central banks are expecting in 2024? I'm just thinking that the market is a little bit too optimistic with respect to these risks.
What does that do especially to my EM trades, the EM disinflation trade, expensive oil, Esther? Does that completely throw it out the window?
Yeah, exactly. I mean, in particular, if you look, for example, at Latin American central banks, they were very sensitive to inflation risks. I mean, yes, they have now started their rate cutting cycle. However, they clearly still show that this is just, adjusting to these extraordinary real interest rates levels they have by now reached. So I think as soon as we are seeing any signs of this inflation supercycle, of inflation levels picking up again and the risk, I think this is emerging market central banks might actually be the one who would be the first to react, in particular as the chances for a soft landing in these countries is quite promising. So I think this might actually where we have to look at for also to determine the risks for the G10 central banks.
Well, maybe that's the bigger divergence play. We're trying to understand China risk this morning. We're looking at it through the prism of the equity market, of miners, and to what extent it's going to impact the world. We've had SocGen say it's fairly contained. The Chinese have the power to contain the angst within the property market. But through the FX prism, the yuan has been literally, unleashed. It's gone lower and lower and lower. From a broader FX, Asia FX perspective, the weakness in the yuan, is it done, or what are the reverberations of this weakening yuan and a China in stress?
Well, the debt risk or the debt problem might be contained to China, but it's clearly showing us that China will not become, a supporter of global growth anytime soon, because the problem will dampen the growth outlook for China for quite some time to come. And this also implies that the yuan will remain under depreciation pressure for quite some time to come. We have seen the PBOC stepping up their verbal intervention if dollar yuan moves too much higher. We have seen that they take several measures to dampen the up move in dollar renminbi. However, this will only, dampen the up move. The pressure is clearly to the upside, and we think it will remain there. So we would need to see, a substantial reduction or a substantial pickup in Chinese economic dynamics for this, for the pressure in dollar renminbi to turn around.
And then what does that feed into Japan, into the yen, Esther? Because you have a Bank of Japan governor who has continually reinforced that they are not there yet with a 2% inflation. If China continues to be a problem child, does he seem more and more right with every single day that passes?
Well, it seems like it, in particular, as long as global inflation levels move lower, there is a high chance that inflation rates will, continue to move longer. As I said, either it will work out for the whole world or it won't work out for the whole world. And for the Bank of Japan, the risks are clearly the highest, So if they wait for inflation to turn lower, as they expect, they might be confirmed with their still ultra-expansionary monetary policy stance. Of course, downside risks to the Chinese economy might help there, actually, because it also dampens the outlook for the Japanese economy. But still, it's not the only thing they can bet on, of course.
So every day, Danny dreams of a more expensive lunch at the Ivy, the original one. She sends me messages with the menu, and she says, now you're in the big dollar league.
It's true.
You can afford this sterling lunch. Look, the ghost of Liz Truss hangs hard. It's a year ago we had the crash. Trussonomics trashed the pound, but the market is rebuilding its short positions. You say it was a tight decision, 5-4 in terms of the pause. When you look at the landscape of the UK, would you be loading up? I mean, the hedgies are loading up to short the pound. Is there renewed pressure to come? Are you a seller of the pound at these levels? We have Nomura talking a really bearish trade on that. Cable this morning, 122.20. So we're near the short point for Nomura. Is it getting tight for you in the pound?
Actually, not. I still think that the pound still looks attractive. It still looks attractive to sell the pound. I think the recent Bank of England's decision has clearly confirmed our view that the Bank of England is very reluctant to do what's necessary to fight inflation. Inflation risks in the UK still look quite high, in particular because they have a strong or quite a high wage inflation compared, for example, to the Eurozone. And even compared to the ECB, the BOE seems more reluctant, as they have shown with, like the recent rate pause. So we have been skeptic for the pound for quite some time now. It was, like too strong in our opinion. So we are seeing the correction we have expected, but we still think the correction to go on further.
All right, good news for Manus, who still owes me lunch at the Ivy. Esther, thank you so much for joining us. Esther Reichelt there of Commerzbank. Now, coming up, we're going to bring you our exclusive interview with UBS CEO Sergio Armati. That's next. This is Bloomberg.
It's Bloomberg Brief, Monday morning with Manus Cranny in New York and Danny Berger in London. UBS CEO Sergio Armati says it's making good progress on the Credit Suisse integration. He sat down with John Liu, Bloomberg's managing editor for Greater China, for a wide-ranging interview in his first trip to Beijing since taking over the helm again at UBS.
Things are progressing very well. We made a shift, very swift progress in integrating Credit Suisse. We closed the transaction in record times, also thanks to the big cooperation of regulators across the globe. And that's one of the reasons why I'm also here today in Beijing, because this is my first trip to Asia since taking on again my role at UBS, and I think it's very important for me to reach out to all the Chinese stakeholders and reiterate our commitment to China, while also updating them on the integration.
In your second quarter results, it mentioned specifically that client confidence, sentiment, and activity here in Asia was muted. Are you still finding that's the case into the third quarter?
Well, I think that we saw in general a little pickup in across the globe, also in Asia, in terms of client activity. The most important topic for us was to see the returns of assets that left Credit Suisse in Q4, Q1 this year. We started to see assets coming back at Credit Suisse towards the end of the second quarter. We see also very good momentum in Q3. So that's the most important issue. But also in general, it's fair to say that investors are more constructive than they have been recently.
So on the momentum you talked about in Q3, there was a net new money inflow of about $16 billion US in 2Q. You said at the time you expected that to continue. What is it looking like in 3Q? What does good momentum mean?
Well, I mean, we are pursuing similar patterns, so we are not going to be specific on numbers. The quarter is still ongoing, but the most important issue is that we see substantially our forecast being confirmed, and we are getting to the close of the quarter. So I think that's very encouraging to see that so quickly our clients are responding to our actions to stabilize Credit Suisse and to offer them the best of the combined organizations.
It's taken your headcount, your staffing, to about 120,000 globally. And you've talked about, pretty forthcoming about the need to reduce that number. How much of a reduction do you think is needed at the end of the day?
I never really spoke about the need of reducing headcount, because it's not our philosophy. What we need to do is to restructure the bank. Credit Suisse needed to be restructured, profoundly restructured, because out of this situation, and then we need to extract the synergies that are necessary to make both businesses viable and stronger. So we are taking actions as we speak to resize the business. We are also taking advantage of the fact that we had natural attrition that is helping. across the globe, we have demographic trends helping in that sense. People exiting the bank through retirements or early retirements. We are working also in facilitating movements of people within the bank, also between the two banks as we speak. So I think that I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
UBS CEO Sergio Ermotti there, speaking exclusively to Bloomberg's John Liu in Beijing, warning about some of the fragility in China. Now, also in China, we have EU Trade Chief Valdis Dombrovskis. He'll be meeting with counterparts and business leaders. Let's bring in Bloomberg's European correspondent Maria Tadeo on this. Maria, what will the message from the trade chief to China be?
Look, it's going to be a striking message, and already we got a glimpse of it today in a speech that Dombrovskis made in China. As you say, he is on an official visit for 4 days. And again, a striking quote that really caught my eye, where he says, at this point, where you look at the relationship between China and the European Union, it is at a crossroad, and it is up to China to figure out whether they want to recalibrate and rebalance, so it is a win-win for both, or inevitably they will have to head in different ways. Let's take a look.
We stand at a crossroads. We can choose a path towards mutually beneficial relations, one which is based on open, fair trade and investment, and working hand in hand on the great challenges of our time. Or we can choose a path that slowly moves us apart, where the shared benefits we enjoyed in recent decades weaken and fade, and as a result where our people and economies face reduced benefits.
So it's a win-win or lose investment. Those are the words of the trade boss for the European Union, Valdis Dombrovskis. And a lot of this, you can see the frustration is underpinned by that trade deficit, which keeps getting bigger. At this point, you're close now to 400 billion euros in a trade deficit that benefits China. The European European Union says they want to see that recalibration and make trade more balanced between the two countries, repeating no to decouple, yes to de-risking, and not an abuse of the single market. If China wants to enter this market, they have to open it up too for European competition.
Okay, Maria. Yeah, and there is pushback here from the States as well in regards to the reach of China into the Middle East and across Africa. Maria Tadeo in our headquarters in Brussels. Coming up on the show, we're going to take a look at some of the market-moving events for you throughout the week. We're going to set the agenda on Bloomberg Brief.